Hi, this is Nicholas Vardy of the Oxford Club, and welcome back to this week's edition of Buy or Buy. In this series of videos, I take a popular stock making media rounds, I strip away all the hype, and I let you know if you should buy now, buy later, or buy never. Our last episode focused on America's top retailer, Walmart, but today I want to tackle the other side of the coin. In fact, you can think of it as the coin itself. Specifically, I want to discuss America's largest and best-known credit card company, Visa Inc., ticker symbol V. Even as investors have been focused on FANG stocks, or worse, Cathie Wood's disruptive technology stocks, Visa has been quietly outperforming the overall stock market as it's been delivering strong financial results that have all but ignored by the mainstream media. Most recently, Visa has been criticized in the media for raising its swipe fees to merchants. Some critics charge the company with stoking inflation, as some merchants threaten to pass costs on to consumers. The increase in Visa swipe fees even attracted the unwelcome attention of the U.S. Senate. That said, Visa stock has been somewhat of a safe haven for investors in 2022. While the S&P 500 has dropped about 13% year to date, Visa is down by only about 1%. And some analysts are now saying Visa can rally as much as 30%, even in the face of the recent market sell-off. So the question is, should you buy Visa stock in advance of its earnings announcement on July 26th, expecting platinum rewards? Or will declining U.S. consumer sentiment and a looming recession lead to the dreaded card declined message? Let me set out the bull case for Visa. First, Visa boasts a remarkably strong market position that I believe is woefully underappreciated by investors. When many consumers think of credit and debit cards, Visa is the company that comes to mind first. Currently, there are more than 3.8 billion Visa cards globally, and Visa transacts literally trillions of dollars in total payment volumes each year. Visa's strong position in the marketplace, what Warren Buffett would call a wide moat, shields it from many of the concerns of most businesses. Yes, COVID-19 was a net negative for current Visa earnings, primarily due to the disruption of high-margin cross-border travel volumes. But the pandemic's acceleration of the shift toward electronic payments will benefit Visa over the long run. Inflation is also less of a threat to Visa than for most companies. That's because most of Visa's revenue is generated through fees calculated on the basis of percentages. That means that fees rise automatically with inflation. Even Visa's unwelcome exit from the Russian market will be largely offset by growth just this year. Second, post-pandemic Visa has delivered better than expected financial results. In Q2 of its financial year of 2022, net revenues increased by a whopping 25% year-on-year to $7.2 billion. This impressive growth was primarily driven by a 24% increase in service revenues, followed by a 16% rise in data processing and a whopping 48% jump in the international transaction revenues. For all of 2022, revenues are forecast to touch $28.7 billion with adjusted net income of $15.2 billion and an annual EPS of $7.09. These are big numbers for what many investors view as a boring stock. Third, by most measures, Visa is undervalued. 21 analysts have issued a buy rating on the company's stock. Only 6 analysts have rated the stock a hold. Based on analyst consensus price target of $267.44, Visa has an upside of roughly 25% from its current price of $214.50. Even Goldman Sachs recently wrote that Visa could rally more than 30% as it successfully navigates surging inflation. Let me move on to the bear case for Visa. First, as I noted above, Visa recently raised its swipe fees, attracting negative publicity in the media. So what are swipe fees? For example, Visa charges a flat rate of about 5 cents to 25 cents and around 1.15% to 3% of the purchase price on every single transaction it processes. Some retailers claim that rising swipe fees will force them to raise prices or to stop accepting Visa altogether. Merchants also point out that Visa is the only vendor they cannot negotiate with. With Visa, it's a take it or leave it proposition. And that in turn smells much like monopoly-like behavior. Second, Visa's strong position in the market has led to the threat of more regulation. Chaired by Senator Richard Durbin, the Senate Judiciary Committee recently held a hearing on swipe fees of leading credit card companies. Now, Durbin is no friend of Visa and was behind a 2010 financial reform that limited debit card interchange fees. With Visa and MasterCard controlling over 80% of the credit card market, Durbin claims Visa faces too little competitive pressure when setting its fees. And increases in swipe fees are hitting consumers and businesses at a time when they can least afford them. Put another way, Visa's market position could be too strong for its own good. Third, despite Durbin's charges, the reality is that Visa is facing more competition than ever from the likes of fintech disruptors like Block and PayPal and many others. Disruptors are fast-growing, nimble businesses, and combined with a shift toward cryptocurrencies as well as alternative payment systems like Venmo for PayPal and the Cash App for Block, the rise of fintechs may signal a fundamental shift in consumers' payment habits that could undercut Visa's rock-solid business model. Now, before I render my final verdict on Visa, I want to tell you about a terrific opportunity here at the Oxford Club. My colleague and the club's chief investment strategist, Alexander Green, has recently uncovered an undervalued stock that could be the cornerstone of your retirement. Now, Alex is a great stock picker, and the Oxford Communique, to which I also contribute alongside Alex, has an exceptional long-term track record. As a recent example, both Alex and I were pounding the table about investing in energy stocks in early 2021. And that call has turned out to be both prescient and profitable. And that's during a market that has been among the most challenging in recent financial memory. So when Alex talks, I always listen. I recommend you do the same. So click the link below to learn more. So now back to Visa. Is it a buy or is it a buy? The upside for the stock includes its remarkably strong market position, its robust growth and better than expected recent financial results, and the stock's current undervaluation, which suggests as much as a 30% upside in the stock. The downside for Visa is a negative blowback from rising swipe fees, the threat of more government regulation capping these fees, and new and nimble competition from the likes of Block, PayPal, and other newer, novel payment systems. My final verdict? I believe Visa is a buy, as in BUY, particularly for long-term investors. Visa is the world's leading payment processor and enjoys a remarkably strong market position. It benefits from a robust and sustainable business model with a wide moat. As a result, Visa is largely immune from many of the headwinds that impact many other companies. No, Visa isn't a whiz-bang story stock, but over the long term, it is very hard to go wrong with Visa. I hope you enjoyed this episode of Buy or Buy. If you did, please hit the like button below. I want to remind you that these are not recommendations actively tracked in any model portfolio. If you want to follow any of my buys or sells, size your position accordingly, set a trailing stop, and never bet more than what you can afford to lose. Thanks for watching, and I'll see you next time on Buy or Buy.